Most people believe investing is something you start only when you have thousands of dollars. They imagine wealthy investors managing huge portfolios, watching stock charts all day, and making complex financial decisions. Because of that belief, many people postpone investing for years. They wait until they earn more money, save a larger amount, or feel more confident about the financial world. But what if that entire idea is wrong? What if the most important investment you ever make is not thousands of dollars, but the very first $100 you decide to invest? That first $100 is not just money entering the market. It is the moment you stop thinking like a spender and start thinking like an investor. And the truth is, in today's world, investing $100 is easier than most beginners realize. In this video on Preston Invests, we are going to walk through exactly how beginners can invest their first $100 step by step. We will talk about where that money can go, why starting small actually works in your favor, and how a small investment can slowly turn into something much bigger over time. To understand why investing even a small amount matters, we first need to understand what investing really means. At its core, investing is simply the act of putting your money into something that has the potential to grow in value over time. Instead of letting your money sit still in a savings account, you place it into assets that can generate returns. Those returns might come from companies growing, markets expanding, or businesses generating profits. Over long periods of time, these returns accumulate and begin to compound. That compounding effect is one of the most powerful forces in finance. Yet many people underestimate how important it is to start early. Think of investing like planting a tree. The day you plant it, the result looks small and almost insignificant. But as time passes, the tree grows stronger and larger. Eventually, it provides shade, fruit, and long-term value. Money behaves in a similar way when it is invested properly. The earlier you plant that financial seed, the more time it has to grow. Now the question becomes simple. Where should your first $100 actually go? For beginners, one of the easiest and most accessible options is the stock market. When you buy a stock, you are purchasing a small ownership stake in a company. That means you participate in the company's success. If the company grows, earns more revenue, and increases its value, the value of your investment also grows. Years ago, investing in the stock market required large amounts of money, but modern investing platforms have changed that completely. Today, many platforms allow something called fractional shares. This means you can buy a small piece of a company rather than needing enough money to purchase a full share. For example, if a company's stock costs several $100s, you can still invest a small portion of that amount. Your $100 can be divided across multiple investments instead of being limited to a single company. This flexibility has made investing much more accessible for beginners around the world. Another popular option for beginners is investing in index funds or exchange-traded funds, often called ETFs. These funds allow you to invest in many companies at the same time. Instead of choosing one individual stock, your investment is spread across dozens or even hundreds of companies. This approach is often considered one of the safest ways to begin investing. Because your money is diversified across many businesses, the risk associated with any single company becomes smaller. Even if one company struggles, others may continue growing. Diversification is a key concept in investing. Experienced investors rarely place all their money into one asset. Instead, they spread their investments across different sectors and industries. This balance helps protect their portfolios from unexpected changes in the market. Once you have chosen where to place your first investment, the next step is understanding how growth actually happens over time. One of the most important concepts in investing is compound growth. Compounding occurs when the returns generated by your investments begin generating additional returns themselves. At first, this process happens slowly, but over longer periods of time, the growth begins to accelerate. Each year, the investment becomes slightly larger, which means future returns are calculated on a larger base. Eventually, this creates a powerful snowball effect. Imagine investing $100 today and then continuing to invest small amounts regularly. Over time, those contributions begin stacking together. The growth from earlier investments adds to the growth of newer investments. As the years pass, the difference between someone who started investing early and someone who delayed investing becomes very noticeable. Consistency plays a huge role in this process. Successful investors rarely rely on one single investment to build wealth. Instead, they invest consistently over long periods of time. Even small contributions made regularly can lead to significant results when combined with compound growth. Another strategy that beginners often use is something called dollar cost averaging. This simply means investing a fixed amount of money at regular intervals, regardless of what the market is doing. Instead of trying to predict whether prices will rise or fall, you continue investing steadily. This approach removes much of the emotional pressure that beginners often feel. Markets move up and down constantly, and trying to perfectly time those movements is extremely difficult. By investing consistently, you naturally buy assets at different prices over time. Of course, it is important to remember that investing always involves some level of risk. Markets do not move upward in a perfectly straight line. There will be periods when prices rise quickly and other periods when prices decline. These fluctuations are a normal part of the investing process. Experienced investors understand that short-term market movements are often unpredictable. Instead of focusing on daily price changes, they focus on long-term growth. Over decades, the overall direction of the market has historically been upward as businesses innovate and economies expand. This long-term perspective is especially important for beginners. When you invest your first $100, the goal is not immediate profit. The goal is learning how investing works and building the habit of allowing your money to grow over time. That habit can eventually transform your entire financial outlook. Once you experience how investing works, it becomes easier to continue building your portfolio. What begins with $100 can gradually expand into hundreds, thousands, or even more as you continue investing consistently. Your first investment is not just about money. It represents a shift in mindset. Instead of seeing money only as something to spend, you begin seeing it as something that can work on your behalf. And that small shift in perspective is often the starting point of long-term financial growth. So if you have been waiting for the perfect moment to begin investing, remember that the perfect moment rarely arrives. What matters most is simply starting. Your first $100 may seem small today, but it can become the beginning of a much larger financial journey. And every successful investor once started with that exact same step.